Let's bring in Robert Luna now, CEO and Chief Investment Strategist at Shorevest. CI Financial Company, CI manages $264 billion in client assets as of November the 30th last year. Joins us from Newport Beach, California.
Hey, what's up, guys? I just got done with an interview on CNBC, talking to Asia, actually, very big audience, millions of people, about the U.S. outlook, U.S. stock market, what's going on here, inflation, how this geopolitical crisis between the Ukraine and Russia is impacting things. And what's great about that interview, I do it once a month usually for CNBC, is I've got about 7 minutes by myself, which you guys know about TV time is almost like having an hour based off of the regular clips that I'm involved with. But, because the market's been so volatile, we're facing such an, monumental shift in the way the economy is working right now. What I wanted to do is just take a few minutes for people on social media who are just now starting to invest in the stock market, maybe investing in real estate, and try to just give you in plain terms, because on financial media, financial television, a lot of the times that's geared more towards the more educated, experienced, and a lot of times actually the professional investor. So I wanted to, kind of break that down. So for people that are in my Wealth Academy, I think one of the most important things to understand and that we teach when you're making investments is the time frame in which those investments are being made and the objective of what you're trying to achieve. Meaning, not all of your assets, so not every investment that you're making is being made for one single reason. So let's say you need to buy a car in 2 years. Well, you might be investing one certain way to do that versus, hey, I need to retire in 25 years. You can imagine that's a much longer time frame, so probably not the same type of investment. Or your emergency fund, for example, if something goes wrong and you need quick access to cash, how are you investing that? So we teach a bucket approach that we'll go ahead and share that soon on social media with everyone to give you a general understanding of that. Bucket one being that short-term emergency money, 2, your income producing money that's paying you dividends. Your bucket 3 is your long-term growth money. So what's really happening with those buckets right now in the economy? Well, it's very simple. Yes, they're talking in the media about Russia, but trust me, I've been doing this since 1998. These geopolitical risks that come and go do not impact the market over a long period of time. They're very short-lived, 1, 2, 3 weeks, right? So that's not what's really moving the market right now. The bigger issue, we talk about it all the time, is rising interest rates and inflation, right? If interest rates are rising, what's happening is it's getting harder and harder to borrow money. And for people who have floating rate debt like credit cards, student loans, like a lot of Americans, that means their payments are going up. So the money that they're bringing in, now more of that is going to credit cards. More of that is going to Sallie Mae to pay their student loans, which means less going to restaurants, less going to buy clothes. And what happens is all those businesses and the economy, which is really, 2/3 driven by the consumer, really starts to slow down, potentially even a recession. So what happens is the companies that are your growth companies, because these are your bucket 3 companies, they do not pay income. Like your Procter & Gamble, Clorox, Coca-Cola, those big stable companies, they don't change too much. They pay you a dividend every quarter, relatively easy to predict. And if you're Procter & Gamble, for example, and you make toothpaste, even if we do have a recession, that's not really going to impact what you're doing. You're still going to brush your teeth, hopefully. Whereas when you look at companies like Roblox, you look at companies like CrowdStrike, you look at companies like Airbnb, these big growth companies that are reinvesting in themselves so that they can grow into the future, that they can dominate a space, are not going to be giving money back to consumers. And people tend to get scared in an environment like this. And if you look at the stock market, even though it's down 7, 8, or 9%, a lot of the big technology stocks have sold off 40, 50, 60%. So what I would say to people is, first of all, if you're investing, make sure you have those buckets in place. Make sure you have a strategy. Your bucket 1, which is your cash type of assets, your bucket 2, which are those dividend paying stocks that we teach in our Wealth Academy. are doing actually really well this year. It's just really the bucket 3 stocks that are getting beaten up. But that's where the opportunity is, guys. One thing I can tell you, the opportunity is not today in bucket 2 that's done well, that everyone's gone to for safety. You obviously don't want to abandon that, but the bucket 3, those growth stocks, that's where you have to start looking. And if you're going to place money into the market that's there for 3-5 years and longer, that's probably going to be your best bang for your buck over the long period of time. That being said, you want a dollar cost average, meaning don't buy it all at once. If you had $100 to invest, maybe 25 today, 25 in a week from now, so forth and so on. When the Fed meets next month to talk about interest rates, that's really going to give us some inclination of what's going to be going on in the future, how quickly they're going to raise rates. What I'm a little bit worried about is this supply chain is still very constrained. When you look at housing, for example, even though we're starting to see at the higher end some cracks, very, very different from where the average home, the average income is going, still a huge constraint on supply there. So even as we see interest rates tick up, I think there's still going to be a lot of money chasing that. The rest of the supply chain, because of COVID, is still backlogged. So I tend to believe that you're going to see inflation numbers continue to tick high until the fourth quarter of this year, potentially into Q1 of next year. That means there's going to be some challenges. That means if you're buying stocks today, do not look to make money in the next 2 or 3 days. Probably going to have to experience some downturn. It's impossible to pick a bottom. I've been doing this for a long period of time. Nobody rings a bell and says now is the time to buy. Nobody rings a bell and says now is the time to sell. That's why you have to have your own discipline, your own financial plan, your own bucketing strategy, and most importantly, have conviction in what you're doing, have a roadmap in place, rules and regulations that prevent you from being just like what most investors do. That's buying high, selling low all the time, following the herd, not what you want to be doing. But the big move today that we're seeing in the market that we'll probably continue to see, Russia's getting the headlines, but it's really what's going on with interest rates. I expect that to continue for the rest of the year. You have to put your long-term cap on, look for opportunity to be able to sell 2-3 years from now, not 2-3 weeks from now. If you take that perspective, that's really what's going to be rewarding to you. If you expect to buy today and make money tomorrow, you're probably going to wind up getting your feelings hurt. So hopefully this just gives you a little bit of insight. I'll also post my clip from CNBC that gives you some little bit more specifics. But wanted to reach out, share some of this information with you guys, especially if you're new investors to the stock market. I hope this helps.